So, Iman, what's up?
I'm good, man. How are you?
Very good. I think before we dive in, I have to give my condolences to Tony Hsieh's family. News broke out yesterday that he tragically passed away. So, for those who don't know, Tony Hsieh, pioneer of Silicon Valley, and then Las Vegas with all the activity and everything he did for the community over there. A true pioneer of startup culture, workplace happiness, founder of Zappos. And so it's definitely touched people a lot. And so, and I can see why with everything that he did. And I think I saw a tweet by Paul Graham who said Tony Hsieh was one of the most thoughtful people in the startup world in both senses of the word. And so, just wanted to, our thoughts and prayers to his family.
Rest in peace, Tony Hsieh.
We also did a revamp of our website, rationalvc.com, threw 2 articles on there. One was mine, one was yours. Mine was just more so my view on the current tech landscape. Yours was an in-depth guide for founders on go-to-market strategy from a strategist point of view. Why you should listen to Iman? Well, he is a strategy consultant at Strategy which as you could call it. He doesn't like to say this, but I do. It's the very exclusive part of PwC where the best consultants go. And so he is a strategy consultant. Check his bio out on our website. He's helped a lot of tech companies and energy tech companies and startups and VCs and unicorns with go-to-market, amongst others. So you've written this article, Iman, which is on our website, a strategist go-to-market strategy guide. And I want to ask you a bunch of questions around it. So last week we spoke about rolling funds, what they do in detail, why they're good, and generally, the whole concept of rolling funds. But I think given that our platform is all about first principles and thinking from first principles, what do rolling funds, sort of solo capitalists and VCs even invest in? We have to drill down even further. We've outlined all of these capital allocation methods, but we've not actually dived into what do they actually invest in, what makes companies successful, how a company can go to market successfully. It's important to understand what good new businesses look like and know what to invest in. So let's kick off with however you want to start this, and then I'll sort of question you and give commentary and sort of.
Sounds good. So I guess the best place to start is we've had 2 episodes now, one which spoke about where we'd invest, and one which spoke about essentially rolling funds as being the sort of democratizer of early stage investing in the markets. So on the basis of that, we thought let's just strip it back and go back to, as you like to say, first principles. What are those first principles? Well, if you're a rolling fund, what the hell are you even investing in? And how do you know what you're investing in is good? And the key for me, or the thing that I've seen over the last 4 or 5 years, is that with tech businesses in particular, your biggest challenge, your biggest sort of step change required to actually getting that initial funding, to growing initially, getting to your Series A, getting venture interest, getting angel interest, is fundamentally down to your go-to-market strategy. What do we mean by go-to-market strategy? Well, go-to-market strategy in its simplest form is just the way in which you take an idea you have for a business, an idea you have for a solution, whatever it might be, a product, and you take that to market. What does taking it to market mean? It just means building the product and selling the product. And implicit within the build and the sell is a lot of complex stuff that you need to whittle down really simply into simple language that idiots like myself can actually understand. Now, the really interesting thing about this stuff is the way I broke it down in the article is there's a lot going on. So if we just simplify to just 2 elements of when you're going to market and you have an idea, you need to be succinct in the way that you have an ambition and you have your actions that sit behind your ambition. Does that make sense so far?
Yes, makes sense.
Okay. So if we want to start with the first section of that, which is our ambition. Ambition fundamentally just means how you set your goals and what the overarching strategy of your business is. And implicit within that is what I like to call your statements. A lot of businesses will do this at various stages of development. So there will be businesses that are bang on the first day one that will need to do this, but there are also businesses that are in their 50th year that will need to keep revamping this because your business strategy changes over time. What are your statements? Your statements are very simply your vision, your mission, your values, and your purpose. Your vision, mission, values are essentially your goals and how you get there. Your purpose is what you're doing beyond the financial. So why you're setting up this business and how to essentially support people. Your ambition also incorporates things like leadership characteristics and communication, the way in which you're communicating your business. And I think in the article I speak about two really famous founders, one Elon Musk and one Jeff Bezos. And the reason I talk about them is because they are not phenomenal orators. They're not your Barack Obamas of the world. It's not that they can sit behind a camera and beautifully wax lyrical about their businesses. It's more so that they can simplify the extreme complexity of their businesses and the ways in which those businesses interplay in Elon Musk's example. And by doing so, give people confidence that one, the product or the business that they're creating is the most important business that is doing that in the market. But two, it does it in such a simple way that it enables anyone to understand what they're doing, which I think is also, as a side note, part of the reason why Tesla's stock price has shot up so much is because a lot of individual investors, private investors are putting their money into Tesla because they understand Elon Musk's vision and they believe in his ability to sort of action that vision. Bezos is the same, man. There's a video I've posted on our website in the article where Bezos is getting absolutely grilled. I think this is in 1998, right? So
I know this video very well. I know.
It's so funny. I mean, like there's this guy, I don't know if it's CNBC or whatever. There's this news guy, right? Obviously, like MBA lad or someone who's got a good understanding of how traditional businesses work, and just sitting there behind the camera grilling Jeff. And Jeff is just like looking at him like, do you know what you're talking about? And the guy just like, well, what is your business? Are you doing real estate? At that point, Amazon was doing a lot of real estate by expanding their network, having to buy land to essentially house all of their stock and bring a lot of their selling capability in-house. So he was just like, well, look, your bottom line, most of that's coming from real estate. You're investing in all these places across the country. You're an internet business. What does an internet business mean? Bear in mind, this is 1998, where internet wasn't such a common thing or such a well understood thing. And the guy was comparing Amazon to internet businesses that were at that point not doing very well. And Jeff just like shuts him down time and time again. He's just like, we're a customer business. We're in the business of making the best products for customers. We're in the business of serving our customers. Whatever the customer wants, that's what we're going to do. And he even says internet schminternet. He doesn't give a shit about the fact that the business is an internet business. He cares about the vision, the mission, the values, and the principles, the purpose of the business. And he links it to something really noble, which is serving a customer and making sure that the consumerism element of our society is at the highest level possible.
This is key, and I've seen this again and again in engineering product teams where, as you've just outlined, they'll go through all of the strategy, mission, and all of these things. That's all well and good, and you should definitely do those things. But I guess they do a lot of this. They do a lot of time building the actual product and strategizing and executing on it instead of actually talking to users. And in the early days, especially, I think the most important thing for you to be doing is speaking to users to sort of, you could call it, mitigate that risk for really understanding the market need for your product. And you don't want to spend all this time up front, especially if you've raised pre-seed, seed, and wasting investors' money and time, really. So, don't worry too much about the nitty gritty, I'd say, of especially engineers, they get really into this, like fixing bugs and tinkering this little thing in this line of code and making it more automated, more scalable, whatever. But really, as we've laughed at this saying before, but boots on the ground, as the tech bros say, you really need to be on the ground, talking to users, really understanding what is the problem you're trying to solve. Because we could debate that this is debatable, but the whole Quibi and some of these companies that invest so much up front and then they go bust or they fail. And look, startups are extremely hard. There's no criticism of Quibi here. But I'm just saying, I don't know what went wrong there, but in a nutshell, I think one of the core underlying issues before companies really hit that sort of rolling bit of success initially down the hill or up the hill is really just not speaking to users. And I think what you said is extremely important there.
Yeah, it's a good point, and it leads quite nicely onto the next section, which is fundamentally around your action. So how are you going to make sure that ambition you initially outline, the strategy, the vision, mission, values, the purpose, your ability to communicate, etc. How does that all translate into the right action, and how do you take it to market? So I think the way I think about this as a strategist is fundamentally, if I were on the other side, and what I mean by that is if I were a investor, particularly in an angel or a VC, and I'm looking at a founder and their value proposition deck, their pitch pack, whatever it is, what the fuck do I want to see and how do I want to see it articulated? And I think being on kind of both sides, I've seen how different people think about this. And everyone has their preferences, right? It's not that there's going to be every founder's going to want to translate their business in the same way, and nor is it going to be that every investor wants to see the same things in the same structure. However, what's really important is you outline your value proposition. Now, if you read the thing I've written, I've tried to simplify everything down under the banner of a value proposition that enables you to translate and articulate your action. A value proposition is really made up of, I guess, 6 different criteria. You picked on number 1, which is your problem. What is the market problem? And when I say market, make sure you listen to that, because what is the market problem you are trying to solve? There can be any problem in society, but it needs a market solution, which is number 2. Your solution and your product. Number 3.
Sorry to cut you off there. Would you agree that most successful startup stories are where the founder is essentially solving his or her own problem? Because that's literally the recurring theme that I see across the landscape is some of the biggest startups are really the founder's just solving his own problem.
That is the number 1 most important thing when you're setting your problem and you're coming up with the solution. Have real insights into what the problem is. The people that tend to do the best, the people that tend to come up with the best solutions, are the people that have had the problem themselves. Much like us trying to do a remote podcast and seeing that not everything works well, right? So the people that have that, by the way, business idea, you should go and set up a new Riverside or something. The problem and solution interplay is really important from the founder perspective, which is making sure the founder knows what the hell they're talking about and if they've experienced that, they're far more likely to do that. But it's also important from the investor perspective, because the investor wants to see that your solution, the thing that you're trying to the way in which you're trying to solve the problem, is not just a product. The worst thing you can do is come with, and technical founders do this more than non-technical, just because they can build, they build something and say, this is sick. Because this is sick, I'm going to find a market problem to apply it to. It doesn't work like that, because you haven't identified the problem, and you're not, much like Bezos, focusing just on the customer. You don't have a central pivot that isn't your product to focus your product on. So you know, the best way to think about it is, don't build a product and then decide to apply it to a problem. Find a problem and then test loads of different ways of solving it, technical, even non-technical. But you don't need to start with the product. The annoying thing about that is I call them product evangelists, but these guys are people that are like, yeah, but there would be no solution without the product. I understand there'll be no solution without the product, but at the same time, there are only a finite number of problems in today's society, but there are multiple ways to solve those problems. My favorite example, and this is going to hit home with you, is blockchain. So like, yeah, that laugh tells me all I fucking need to know. The blockchain was, you know, part of the creation of Bitcoin, and correct me, you know a lot more about this than I do, but part of the creation of Bitcoin was the creation of the back-end blockchain. Blockchain was then seen as this really cool thing when Bitcoin began to blow up, what was it, 2017, 2018, and then all big corporates started saying, we need to use blockchain. How are we going to use blockchain? Then there was a whole series of startups that started emerging that said, we're doing this cool thing with blockchain and this cool thing with blockchain. And it's like, motherfucker, I don't care what you're doing with blockchain. I care about the problem that you're trying to solve. So anyway, that's my rant over around that initial.
I think what's going to happen is you're going to get a bunch of Bitcoin, or more so blockchain maximalists or whatever, which is kind of like a cult or a religion. It literally is a cult. They're going to come at you, and we're going to get several dislikes. So yes, please. You're welcome.
I have nothing against crypto. I even have crypto, and I have nothing against blockchain.
Yeah,
all I'm saying is,
but you're speculating, right? Because it's
exactly,
money that you're willing to lose. It's probably 1% of your portfolio, or sub 5%.
It's definitely sub 5%. Probably around 1%. But the point is, it's a speculative asset, and you've talked about this in our previous episodes. Don't chuck money at speculative assets. Don't waste your money. Don't throw your money down the drain if you don't know where it's going.
Best way I would put it for anyone, just as a side note, because people may listen to this for potential investment ideas, is I'd say someone like Chamath, who invested in Bitcoin in 2012 and got in the space early, to this day, which he's very bullish on crypto, it's still only 1% of his portfolio, because he says that it's money I'm willing to lose, which is what I've always been saying as well, and what I advise. I'm not against it, just use sub 5%, it's speculation. But yeah, carry on.
It's a good point. So we outlined the first and the second thing that sit behind your value proposition, which is your problem and your solution / product. Why? And I guess it's more a question for you, because you've had a lot of experience in this, and you see it day to day in your job. I've spoken about the product shouldn't come first, but what other pitfalls do you see in your day-to-day job around product development, product management, whatever it might be?
Sure. So best way to put it is, in the UK especially, this really annoys me, because we have these fantastic product managers and CPOs and product leads all in the US. I'm not saying there are none of those in the UK, but what I see across the landscape, we have a lot less good, solid PMs like we do in the Valley. And so how do we really improve any product? And so I suppose the first thing is we need to reverse engineer the whole process and what we're measuring as quote unquote improvement. I guess company leaders, they're desperate for someone to own outcomes. And a few people have spoken about this, Keith Raboy, Frank Slootman, even a company called Divi in the US. I believe the head of product, Tyler Hogg, he's spoken about this. He has an article on this. He was interviewed. Basically, in a nutshell, company leaders are desperate for someone to own outcomes, what Keith Raboy would call barrels, Frank Slootman calls drivers, etc. And I guess sales kind of does this naturally because the outcome of sales is their number. In the UK especially, me and you have a lot of friends in tech. One of my friends who is ex-head of engineering at a big UK tech company, I won't mention who, he mentioned to me, in his eyes, in his view, he's worked with a lot of PMs. He says PMs are charlatans. In the UK, from what he's experienced, right?
But can I just butt in there? I'm gonna get a lot of Bitcoin people disliking this video. You're gonna get a lot of PMs disliking that.
Yeah, but I'm in product. Like, part of what I do is basically product, and so I partially agree with him. I think he was being a bit aggressive with his terminology, but his view was also that he agrees with me and all of these, people that have way more experience than me that have voiced their concerns on this, is that PMs should own or co-own all business outcomes, right? And I guess the problem is, think of PMs on like a spectrum. One extreme, you have PMs, which is sort of the UK nonsense PM that you have, which is project management, this Scrum Master nonsense, and all of this stuff. On the other extreme, you have the PM being literally, as they call it in the Valley, the mini CEO or the GM, the general manager of the product area. Rather than shipping software, they are shipping outcomes, right? So basically what I think, and what these people that have a lot more experience than me think, the most successful product guys, that the CEO general manager framing is the correct one. Product managers are actually general managers. This doesn't mean that you must own a full profit and loss, although this does happen. But I guess you must own an outcome, and that outcome does not have to be revenue. And so what this means in practice is that we can divide all the outcomes and you can share them across your product managers. So collectively, product managers, they own things such as contribution margin, net retention, customer acquisition cost or payback, monthly revenue, which you essentially co-own with sales, the ramping of customers, so that you could say on a month-on-month basis, co-ownership with sales again, and also sign-up volume, which is kind of in the same sort of metric area. So PMs own actual revenue numbers for products, sometimes jointly with the revenue team, which means revenue and product teams are much more tightly aligned. And PMs, which is what I've been advised by some mentors, and some of these mentors are actual mentors of mine that I know and speak to. And some of them, I call them cyber mentors, where people I've never met, but I've read their books or I've read their detailed articles online. And so what I've taken away and what I've seen among the successful product teams and what I've implemented that has successfully worked in the past is where, for example, PMs sell. And I guess me coming from, we spoke about this in one of the earlier episodes, which is learn to build, learn to sell. As Naval Ravikant says, we can't go an episode without mentioning Naval.
Shout out Naval. He liked our latest tweet, so our latest episode on Rolling Funds. So shout out Naval.
Yeah. He liked the promo tweet of the Rolling Funds episode. So anyway, learn to build, learn to sell. Well, I guess this is the benefit of, if you have sales experience or biz dev experience or commercial experience before being a PM, which not many PMs do, but I did, is PMs should actually be selling as well. So they should join sales calls, they should give demos, they should travel to on-site client visits. And so product, jointly with revenue, owns the onboarding and sort of sign up for all new companies, and exclusively owns the sign up and onboarding of, let's say, when the company is really young, that's what they should be doing. So sales can focus on the larger deals. And there's this argument of, you don't bring in product managers until you've got at least 20 employees. Fine, agreed. But regardless, PMs have goals for the number of new customer, you could call it, the customers that sign up, as well as the rate that new customers are onboarded successfully. And so PMs should really lead product reviews every 2 weeks, which are treated as sort of a board meeting with the exec team and other stakeholders, and just to sort of wrap up on my thoughts here, because this is one of the biggest pitfalls I see, is, as I've just said, no ownership of outcomes which they should have. And so they fall in, you asked for the pitfall, which I've outlined, and just to wrap up on this, PMs often fall into the trap of thinking about when a product would ship and what the deliverables are, etc., rather than the outcomes attached to it, which I keep sort of going over and over again. I'm really emphasizing this point. And it's not to say, look, shipping is an unimportant aspect of the PM role. Yes, successful execution, predictable delivery, they're all critical to sort of that steady up and to the right trajectory while keeping customers happy. One lens should be firmly positioned on advocating for the customer, and another lens focus on the results of the business. So one side of the brain is being logical, making data-driven decisions. And I guess the other side is acknowledging the emotion and having empathy for the user. So yeah, you know, we've addressed that. We've laid the sort of foundation for successful product improvement, pitfalls. And I guess the next step, which kind of leads on to your expertise, is traditionally PMs are advised to follow a framework of 1, business objective, 2, user problems, and 3, solutions, which kind of goes into your world. But none of that would be successful without what I just explained, laying the foundations of a successful, you could call it, product strategy, and avoiding the common pitfalls of product strategy, and PMs not taking ownership. And look, in the early days, you don't have a PM. When you're sub 20 employees, you probably won't have a PM. It's probably the CEO and some of the other team members and engineering taking control of product as well. So these still apply to you, even if you're not a PM, but you're taking control of the product function until you hire a PM and you hit scale or you raise funding. So these are things essentially for people to be aware of, even if they are not a PM, but they're acting as a product function until they hire. You must own outcome, at least an outcome or two, and divide the outcomes between yourself.
I like that because it gives clarity to PM teams around product market fit. So it's essentially telling product teams that you need to stay true to your ambition. You need to stay true to your North Star. And the way to do it is to divvy up the way in which you go to market and what your KPIs are, what you're tracked on. So I like that a lot. For people that don't understand a lot about product, I would also say simplify the product down when you're articulating it, particularly in your pitch pack and in your value proposition, is build a really simple user engagement story or something of that nature, and then show the technical apparatus in the back end that helps deliver that user engagement story, because it makes it a lot realer. And then you're like, oh my God, this is such a cool feature on the app. But then you're explaining to the investor, yeah, but this is what's driving it. But you're leading with this is the cool thing on the app, right? So from that perspective, I'd be clear on that.
Just to add as well, you also need to define the sort of business objectives or metrics that you take ownership of. And so it's questions like, essentially, best way to put it, potential metrics to focus on. You kind of need to think about, and this is obviously falls into more your expertise, thinking about the life cycle of a typical user, in that, you know, following the framework of business objectives, user problems, solutions, and then your go-to market is potential metrics being acquisition. You know, are we trying to grow volume or user acquisition, or decrease cost, or activation? Are we trying to improve the percentage of registered users who become active, or engagements, or retention, or revenue, or referral? And there's a bunch of things, and you kind of have to essentially, the whole process is, as you've said as well, you've got to reverse engineer, and you've got to assess these things so you know what you're measuring, which goes back to the point I made around fit. One side of it is 50% of it is really the logical, rational side of the brain, making data-driven decisions, which is, i.e. these things, following the KPIs. And the other side of it is acknowledging emotion and having empathy for the user. One problem I see, to really make this give you a simple example, is the misalignment between listening to users and what they're actually doing. Great example is Facebook. So I'm sure your great aunt, who likes to watch, I don't know, cat videos or these conspiracy misinformation, whatever, on the Facebook newsfeed. She's browsing as she does. And then one day she turns around and starts complaining, Iman, they've changed Facebook again. It looks horrible. I hate it. We say, okay. And I'm sure the Facebook PMs hear that a lot when they make changes. And then 2 days later, 3 days later, those people could not actually imagine going back to the old version because they've adjusted so much. So what I would say is it can get very complex, but to really simplify it is you've got to be tracking both. You've got to be tracking the data, the metrics, the KPIs, based on the sort of objectives, the problems and solutions, which obviously you touch on. And the other side is really, yes, you acknowledge emotion and have empathy for the user, but especially in a B2C market, users are fickle. We're all, in a sense, we're all fickle, you know? This is why I like to study mental models, to try and be as rational as possible, to catch myself out when making suboptimal decisions. But yeah.
That's a really interesting point about my great aunt. So thank you for shouting her out. But the other point is, you mentioned Facebook, well, Instagram as well. Instagram recently did an update where you don't have Instagram, so I know you don't necessarily know this, but the like button, so where your engagement on your account would come up, would be on the bottom right. They've now replaced that with the shop button. So your mind that typically would press the bottom right to get onto to your engagement is now just taking you to shops, to sales. So you know that's obviously done with a lot of thought around, okay, where are our users pressing on the app the most, etc. What are they using the most, and how can we monetize it more? So yeah, the last point I just want to raise. So we've talked about solution and product and the pitfalls of product. We've talked about the problem, the sort of interplay of problem and solution. The last thing I just want to say is, if you've got a checklist of things that you need to tick off with a problem, and you don't know if a problem is big enough or a market problem, there's a number of criteria. I've linked a video in my article, but I'll also link it to this video that outlines, you know, the key areas that we should be looking for in terms of problems. For me, their problem is popular, growing, urgent, expensive, mandatory, and frequent. You can read my article to understand more about those. But the key one is popular. You want to have a large total addressable market. You want to have a lot of people having this problem. And you want to show what those people look like.
Yeah. I'd say just one other really interesting thing I came across recently is product manager by the name of Shreyas Doshi, who formerly Twitter, Google, Yahoo, and then he was an early product manager and the first lead product manager at Stripe, where he's currently at. I've had a Twitter exchange with him once before on the feed, where he had a really thought-provoking thread, and I said he was literally applying mental models to product management, and I said, "Wow, it's literally the Charlie Munger of product." Wow. So I gave him a really good compliment, because I think Shreyas is great. But he has this little, well, it's not little, but it's probably a 2-minute read. It's not very long. Article on why do smart product people and teams often build products with mediocre or zero impact. And he says, a cautionary survey of the biases and fallacies we encounter when building products. The 7 biases of product teams. And so number 1, I'll read these out very quickly. I'd like to get your thoughts on these. He says, number 1, the execution orientation fallacy. We craft flawed product strategies and make suboptimal product decisions because we base these decisions on what we know we can easily execute today. Short-sightedness and low agency typically cause this fallacy. I see this one all the time. Number 2, the bias for building fallacy. We don't take the time to thoroughly understand the problem, domain, competitors, and other determinants of product success because we feel compelled to be in constant motion. We tell ourselves we must begin building and just iterate based on feedback. Number 3, the IKEA effect for products, usually applicable to an existing product that's struggling. We base our current product decisions on past product execution because we're too attached to the work we've already put in and don't want it to have been for nothing, which sunk cost really. Number 4, the focusing illusion for products. when we talk to customers about the problem that our product solves, we overestimate its severity and get surprised when the customer doesn't end up buying or using our product. Any problem will feel more critical while you're talking about it. Number 5, Maslow's hammer. We use a framework, a skill, or a proxy that we are most comfortable with, or one that our company endorses, even when its utility is limited or counterproductive in a specific product context. Example, Facebook uses metrics as a hammer for its products. A number of its past and current woes can be traced back to an indiscriminate use of this hammer. There's just 2 more left. Number 6, the authority approval bias. We devise product strategies, conceive product features, and propose product plans based largely on what we think is going to either confirm the beliefs held by those in position of authority at the company or more easily get us approval to proceed. And people know my thoughts on that. And number 7, Russian roulette for products. We don't account enough for scenarios that could, under certain conditions, lead to a catastrophic outcome for our product or a PR nightmare for our company, usually found in companies where following orders or quote unquote just get it done is rewarded.
He's a Shakespearean orator and writer, isn't he?
He is. Of product.
Of product, of course. as technical as product is, he Shakespeareans it. He is in it. His inner Shakespeare emerges. It's beautiful. I like the. Which one was the sunk cost one? Was that the IKEA one?
The IKEA one, yes.
Yeah, that's quite interesting. That you see that actually in all walks of life. It's not just product. Like when people put effort into stuff and they just keep going with it. In a lot of ways, that's a good thing. But in terms of user engagement and the product development, you need to iterate fast and keep moving. I guess it's the whole agile process of building. But anyway, we've spent quite a while on the product and the solution, and the reason why we have is because it's bloody important. So we've outlined our problem, we've outlined the solution and the product that sits behind it. What do you practically do to take those things to market, and how do you articulate it? Well, you need to think about 3 things really, which are your target customers, i.e. who's going to be buying your stuff, what channels you'll be selling to them through, i.e. how will they get your stuff, and then how quickly will they get your stuff? What's the time frame that your startup will reach target customers? There's the famous, there's a book, a 1962 book that I reference in my article, which is The Diffusion of Innovations by Everett Rogers. Now, although it's a really old concept, it kind of still holds true in the sense that what this graph shows us is tech adoption by different types of people. So, this is where the whole early adopters thing comes from, an early majority, late majority, where your innovators sit. And the graph surmises that innovators take something like 2.5% of total people. Early adopters are something like 13.5% of total people. So realistically, when you're setting up a business, you really want to be targeting those early adopters and converting those early majority. So the sort of first 3 buckets of that graph, you can see the graph on my article, but you need to especially with tech products, you need to target people that really fall into that early adopter group. And what do those people look like? Well, they're younger typically. They have a little bit of money. They have and they want to spend it on tech. They're well connected. Go for people that have large Twitter, Instagram, YouTube, etc. followings, and that are thought leaders and people respect their opinion. This is why there's so much influencer marketing. And
great example of leveraging influencer marketing was, of course, Gymshark in the e-commerce space. I remember early on, I won't name who, but there was a successful e-commerce company sitting in their boardroom when I was in banking, and I was telling their CEO, for marketing, you guys should really take a look at Gymshark. They basically hire the most popular YouTubers from around the world in the fitness space to essentially market their products, sponsored athletes. And obviously we've seen the result of that a few years later, now valued at $1.5 billion. I think it's the first fitness e-commerce brand with the influencer model that's really hit scale on those numbers. So 100%, I think it's really underestimated the importance of, in this attention economy, leveraging the people who have already developed that network and following, rather than you spending years. Because look, some of it, for example, in let's say the fitness space, those guys have spent 10 years uploading videos to build that following. You're not going to get that overnight. And so I think the sponsorship model, depending on your business model, I mean, we've seen recently companies like NordVPN and Surfshark have been doing sponsorships on every YouTuber's thing. Maybe YouTube's not your thing, fine, but find a way to tap into some type of sponsorship under people that have an influence in your niche.
It's a good point, and I think it's relevant because a lot of these tech businesses are B2C, they're consumer businesses, and so if you do have a consumer business, consider where people are spending a lot of their time. Well, that tends to be on socials, and if you're going to spend a lot of time on socials, the customer acquisition cost, I don't know what it compares to in traditional marketing, but I'm almost certain it'll be less. So you're actually getting more bang for your buck as well. There's other criteria around being early adopters as well, being more progressive, more educated, and therefore more likely to purchase the product.
And I'd also say a higher, probably as talented as you can get, a growth person who will deal with a lot of these things, such as, I can do a whole episode on formulating your strategic partnership sort of structure, strategy, framework, whatever. But it's a combination. Your growth person is in charge of your strategic partnerships, your affiliates, things like your paid traffic online marketing, SEO, influencers, affiliates, which I've already said. So if you don't have a growth person, you need to be aware of all of these things. And what do I mean? Well, yes, previously, I had a focus on doing a SaaS tool, growth marketing SaaS tool for enterprise customers. And I probably shouldn't say this, but it's true. Well, to be honest, those companies had already hit scale. They were pretty large, e-commerce players. But if you're a young up and coming company, you shouldn't be sinking investor money into paid traffic. Like, for example, I touched on this in my article, Casper.com, flipping mattresses online. Wow, much innovation. Those guys have I believe they're paying $350 for each client, essentially, in terms of you're looking at acquisition costs.
That's $350, not $3.50.
Yes. So they're losing money. Obviously, feel free to read that article for further insight and me ranting, but you need to be very cautious with these things early on as well. And I'd say hiring one person who is rock solid at either growth and or business development, and just uses out of the box strategies and thinks outside the box, because what you want is especially for your initial traction, or call it your first 1,000 users or whatever, dependent on your company and what you do, it needs to be organic users, organic growth, people that have come to you rather than you paying a ton of money on paid traffic. It's not viable. There's no longevity in that. It's not a sticky customer base. So you should really be focused on organic methods. How? Well, there's a zillion trillion ideas. It's dependent on your niche. A very basic example of this is, wasn't it the Airbnb guys, where early in the days, and I'm sure you could read on this a lot better than I can explain, but in the early days of Airbnb, they did all sorts of things, such as, I think they joined a political campaign, and they did all these wacky things. They sold cereal that had the Airbnb logo on it or something. I don't know the exact details, but basically it just completely depends on your niche, and you should think really outside the box. It's not easy. It's probably the toughest thing for you to get your first few hundred users. If it was easy, everyone would do it. But I think that also takes a large chunk of thought in this whole product and go-to-market process.
There's an interesting point that links back to what we were talking about earlier, which is the founder should experience the problem themselves. The reason we say that is because if the founder is experiencing the problem themselves, they're likely to know people, their mates, their circles, whatever, that have the same problem. So your initial outreach capability is much wider. If you're solving a problem you found on the internet 3 days ago, the likelihood of you finding people that have the same problem is very low. And so your ability to go to market quickly and gain users through organic means quickly is very limited. The you picked on a couple of points on the how to attract people, how to grow your initial user base. That hits on point number 2 around my go-to-market plan, which is around your channels. And I break it down into 3 things, right? So you've got your attraction, your engagement, and your nurturing. You picked up on attraction really well. You can either pay for people, I don't know how that, paid online marketing, online ads, social marketing, etc. You can either do it through traditional methods like trade shows and in-store displays, but you need to have earned those customers in a way, which is around your more organic methods of natural search and SEO methods, your PR, your social referrals, your wacky stuff like having your brand on a cereal box, app ratings, which are really big. And then once you get them, it's kind of like, how do you convert them to start using your platform consistently for the product that you're selling? So it's not that you offer the cheapest product and therefore they come to you, but then they leave you and go back to the original supplier. It's about getting them on your website, on your app, on your socials, engaging them through your social media platforms and linking in with influencers. So through that perspective, I think there's a lot you could do, and there's a lot of research people can do online to figure that stuff out. The way in which you attract and then you earn them then needs to kind of be backed up by engaging them right and nurturing them right. So engaging them through consistent, I don't know, if it's nudges or whatever on the phone, if it's newsletters and emails, if it's opt-in content, if it's making the user essentially feel part of the process of that business, and then rewarding them for that. So nurturing them. So customer loyalty rewards, giving them discounts for being members for a certain period of time, doing more targeted advertising specific to that customer. So there is a lot to be said around this, and I think you have a lot of insight in this from your previous venture. But the key point is that you engage people, attract them right, do it organically, but also know who you're attracting. So making sure they're as part of the diffusion of innovations, that tech diagram, that it falls at the right space of people that you're targeting. And finally, all it is doing it in the right time frame, which I'll gloss over, but realistically, you should be setting up a business in 3 months. You can't set up a business and take 10 months to get it off the ground. Just get an MVP out there, get a product, get a pitch pack, get a value proposition, like put all this thought together. You can do it in 3 months.
Yeah, user problems, prioritize that and everything that we've outlined. And I agree with the whole, paid traffic thing that you just touched on and I touched on as well. There's no longevity in that is the only thing I'll say, because I get founders occasionally coming to me or messaging me saying, hey, I want to do paid traffic. What do you advise? Where should I go? And I'm like, don't. That's a simple way to put it. Leverage your biz dev guide for email outreach, which I think is still one of the most underutilized things. I could do a whole episode on successful strategies for, let's say, outreach and how to get your first clients with a sort of personalized touch to get them to sign up. But anyway, I think we've covered a whole ton of stuff. I know that there's still things on as part of this formula that you have of go-to-market. Based on your article anyway, there's things still on the team and on financials. I think I'm happy for you to touch on it briefly. But I think in the interest of time, I think team in itself, we could do a whole episode on in the sense that we can cover everything you've written around the importance of team. And secondly, around what I can touch on as well is around hiring practices and cultural practices. And again, rest in peace to Tony Hsieh, his methodology, people like Patty McCord of Netflix and what she did with Reed Hastings in the culture that they built. So I think we could cover a lot around team, and then financials, obviously the two of us both coming from finance backgrounds. We can cover a lot there from early stage all the way up to late stage and corporate. Generally everything from pricing all the way to the actual financials that could also sort of affect your fundraising process as well. And if you're a corporate, then your roadshow for IPO.
The financials is is more technical, so I won't deep dive into that. You can read the article for more understanding of what investors look for and what founders should care about. Hint, hint. It's around the gross margin pricing and costs stuff. But put financials aside for a second. The most important thing out of anything we talk about, we've spoken about problems and solutions and products and your go-to-market methodology. Forget all of that. The most important thing is who you work with and how you build a culture around that. And it goes back to the point of the founder having the problem themselves. If the founder has the problem and the founder understands the business innately, the founder sets the foundation for the business and can therefore hire people that understand the problem deeply. That's who you want. You want people that get this shit as well as you do. And you want people that have variable skill sets, so things that you're not good at. And you need to be able to identify what good skill sets look like when you're not someone that has that skill set. It's a very hard thing to do, but what you can do is you can find passion in people that have had the same problem, and you can utilize that as a way of leveraging a better ability to essentially find people. The biggest thing that turns investors off, I guess, is team. Everything else can be fixed around it. Everything else we've spoken about can be edited. The thing that can't be is the people that are running the business. So to finish off with a bang, the last piece of the puzzle is probably the most important. Yeah,
and there are points made on this where, you know, people will be paying at the 50th percentile of the industry. That's not going to work. I think the best thing to refer back to is Patty McCord and Reed Hastings' formula of hire the best, pay the best, have the highest of expectations. If it doesn't work out, then you give them a severance package. But you set expectations so high up front that it's likely that won't happen. If you're paying top of the market 100th percentile, then you expect 100% outcomes. And so I think there's many things around team, obviously that being one small element of it. For example, what you pay, how you do the hiring, who you hire, the expectations you set, the culture. I mention this occasionally, but literally how you read people, the laws of human nature, the mental models you use in assessing people, and if they are full of BS or if they are really competent. I know in the Value, for example, I forgot who it was, but one of the senior sales guys, I think he was moving over to Andreessen Horowitz many years ago, and I think it may have been Mark Andreessen or someone at the firm, went through, may have been 60 or 70 references before hiring this guy. And so that's really the level of detail. Of course, if you're early stage, yes, look, you can't do a million things at once. But what I would say is just be very conscious and be very, very aware, and touching on really your points, emphasizing on those. Make it a key area of your focus, because that's the foundational structure of everything that you build. So probably the hardest thing in startup, I think the hardest thing by far is hiring.
Every founder that we know consistently says that the hardest thing they do is hire and fire. So if you're looking to enter the tech market and you're setting up a business, don't think it's all rosy. It's going to be tough when you're going to have to fire the wrong people.
What? I thought it's champagne lifestyle.
Spraying at the club every weekend with that VC money, right?
Models and bottles, as they call it in banking. But then you join and you realize it's financial models and an Evian bottle. Anyway,
it's not even Evian, mate. It's Tesco's finest.
I think we've touched on quite a lot. Is there anything else on this topic that you want to wrap up with?
No. All I'd say is read the article. It's got a lot of insightful information in it, if I do say so myself. But at the same time, reach out to us if you've got any questions, anything that you need more clarity on, or anything you want to challenge.
Yes, you can find our articles on rationalvc.com. We also have newsletter. For now, the cadence, once a month, long form essay. It's called the Rational Letter, and you get very detailed, helpful guides such as the one that Iman has written on go-to-market strategy. And we both write articles. So I think before we wrap up, a new thing I want to do, which I said to you, is whenever we do episodes together, I want to do like a tweet of the week, like a tweet that you've seen, if you have one.
Can we get a siren? Can we get a siren at the end of the episode that just goes, tweet of the week, baby?
Like one of those hip hop DJs that puts 10 sirens on every freestyle. I'll go first. The tweet that I saw. Tweet is by at Kevin Yin, Kevin Yen. He is, I think he heads up product at Square. So, sounds great. Sounds like a lot of fun. It says, your career is not a ladder, it's a game. Those who treat it like a ladder will make linear progress at best and let their fear hold them back. Those who treat it like a game will collect the resources, find the people, and build the skills that compound, and have fun doing it. I absolutely love this tweet. I don't think I even need to say anything. He's basically summed it up himself eloquently.
You're lost for words.
I'm lost for words. Amazing tweet. And I think this goes back to one of the earlier episodes we did on careers in tech, careers in VC, being an operator, being an investor, young people who come to us for advice occasionally on how to navigate their careers, where to join, what to do, etc. I basically say that summarizes not everything I said on that episode, but if you could just take away one thing, it's that. Don't go the old model of linear corporate sitting in my cubicle trajectory career path, in my view, is out over the next decade or two. Do what Kevin Yin says, treat it like a game, collect the resources, find the people, and build the skills that compound. Anyway, I love that tweet. If you have one, what's your favorite tweet that you've seen in the past week?
So just in terms of we've just come out of Black Friday, so this tweet has been really interesting. It's by James Ho. It's James JHO _ on Twitter. He's a principal of Altimeter Capital, and he's tweeted about Shopify. And this stat blew my mind, but Shopify accounts for about 7% of US e-commerce. But during Black Friday, it had almost 1/5 of Black Friday sales, 18%, which it was equivalent to $2.4 billion. So Shopify absolutely killed it this year. But interestingly, James says that essentially the thing that led to it is there's a democratization of purchasing power. People can buy and sell whatever they want individually, especially for D2C brands, but it's also enabled by the strong execution that Shopify's had. I'd like to deep dive more into what that strong execution looks like, but if you look at their share of Black Friday 2018 to 2020, it went from 9% to 12% to 18% in 2020. So they are ballooning at the minute.
We can't go an episode without mentioning democratization. So there you have it, ladies and gents. Yeah, I think that's everything for this week. Look, from next week, we've got guests on. Iman, I think you need to... So when me and Iman record in person, we have these two huge studio lights. They're both at Iman's now, which you can see he has fantastic lighting. I think you need to drop one of those lights off here, please, because it looks like I'm in a dungeon. And
I like the studio setup I've got here.
So as I said, first few episodes, look, we said we're going to step up the production quality. We've both got the mics, we've both got the DSLR cameras streaming off of this whatever we're doing right now, and lighting setup. Bear with us, guys. We're stepping it up. Steven Spielberg, watch out very soon. Next week, guest, and then from there on it's pretty much guests all the time. Christmas period, me and you are going to do quite a few episodes together. I'd say 80% of our episodes going forward roughly are with guests, 20% of just me and you, like today's episode. And stay tuned. Anything else, Iman?
That's it. Peace.